Welcome to those of you who are on our webinar right now. I'm Carl Stamp, Executive Director in Brainerd at the Community Foundation there. We're going to wait just a minute or two while the other participants join us in the room. Okay, it looks like we have a pause in entrance into the webinar. Once again, I'm Carl Stamp, Executive Director of the Brainerd Lakes Area Community Foundation, one of the partners of Community Giving. We'd like to welcome you to our Professional Advisor webinar series, Qualified Plans and Testamentary Plan Gifts. We're delighted you join us. At the end of the webinar, you'll see how to view a recording. So if you want to refer to anyone, you can, or if you want to see any of other recorded webinars, you will get information on how to access those. So again, thank you for joining us today. Make sure as we hear from our presenters and you think of questions that you use the Q&A tab down at the bottom of your screen. So if you just hover down there, that bubble should pop up and you can type your question in there and we will get to that question a little bit later. So now to introduce our presenters for the day, I'd like to introduce our CEO and President, Steve Jewell.
Thanks, Carl, and welcome everybody. We're really glad to have everybody with us today. The topic that we're talking about is a topic that over the years, we've probably generated some of the most questions we've ever had on these types of gifts. And that is, we'll be talking about qualified plans and testamentary plan gifts, and in some ways combining them and working together. Qualified plans often end up being a major asset for many individuals. And as individuals who are charitable start contemplating what they can do to impact their local communities, they end up asking us questions about what they can and cannot do with the qualified plan. So in order to really help answer the questions that are out there regarding using these these assets for making charitable gifts, we thought we'd go right to some of the experts in the field, and we're very, very fortunate to be joined today by some outstanding panelists. I'm going to introduce all of them here at the beginning, and then they will just be each giving us a short presentation from where they sit and their angle on a particular aspect, and then they'll have conversation amongst themselves. And then we'll be opening up for questions from the audience. So if you do have questions as we go through today's session, please just enter your question in the Q&A, and we definitely will have time to get to that. Starting us off today is going to be Jeff Schultz. Jeff is a senior wealth advisor with Bremer and has been in the field for a number of years and very experienced. Also happens to be a board member of the Wilmer Area Community Foundation. We're delighted to have Jeff with us. And then we'll hear from Cheryl Morrison, who is well known in the state of Minnesota. She's with Lanthrop GPM, and she has done many presentations in the areas of planned and deferred giving, one of our experts in Minnesota on the topic and legal aspects of making charitable gifts, and we're delighted to have Sheryl with us. Cindy Bock will be joining us. Also, very experienced technical director and experienced in taxation with CliftonLarsonAllen, as well as Andrew Ostlund, who has a long history in the wealth advisory world and is currently with CliftonLarsonAllen Wealth Advisors. Both Cindy and Andrew are out of their Brainerd Lakes, or northern office, I guess it's called, the northern office of CliftonLarsonAllen. And we're delighted to have both Andrew and Cindy with us today. So to kick us off, I'm going to turn it over to Jeff. And Jeff, looking forward to your presentation.
Great. Thank you for that introduction, Steve, and welcome everybody. I was asked to talk about specifically the qualified plan portion. And for the purpose of this presentation, I would just ask, when I say qualified plan, they come in many different forms and tax code numbers. But I'm mainly talking about IRAs, which is the primary asset that most of our clients see and utilize would be traditional IRAs. A lot of this would carry into other types of qualified plans, but that's mainly what I'm talking about. Some of the overview points on qualified plans or IRAs. which most of us know, they do offer tax deferral to the owners. They can take their accumulated savings, roll it over from the 401k or 403b into that traditional IRA and continue to defer that income tax. The required minimum distributions, or RMDs, that are required by the IRS now begin at age 72. Prior to last year's tax reform, it had been 70 and a half. So that was a recent change. And we still have clients seem to miss that from time to time. And then one of the things that we find with our clientele, and many of you probably do as well, is it tends to be a client's least beneficial asset in terms of accomplishing their goals. If they've accumulated some level of wealth, this asset that's 100% ordinary income to them and their family probably isn't the most beneficial thing that they own for themselves. And the main reasons I say that are the fact that there is ordinary income built in, whether it's to the owner, the beneficiary, even if it's a spouse or a non-spouse. It has an issue called IRD, income in respect of decedent. And that basically just means somebody someday will pay the tax on this unless it's a charity. We really look at other options when we start talking about a taxable estate. So when I say least beneficial asset, I'm really thinking there, especially in a situation where a client has a taxable estate and you're talking about paying estate taxes on unpaid income taxes that will be paid at some future date. That's where we really start to try to get creative about what can we do with these qualified plans for these clients. Amy, if you want there, thank you. One of the things that a lot of our clients utilize, and I know community giving and all of our community foundations love this, is qualified charitable disbursements, or excuse me, distributions. I always get that confused. The qualified charitable distributions, or QCDs, can still begin at 70 and a half. That did not change like the RMDs did. One of the things to note is you actually do have to be 70 and a half. So it's not the calendar year in which the client attains the age. They have to actually be 70 and a half in order to utilize the QCD. It needs to be paid directly to the nonprofit. We do occasionally have clients who want to deliver the checks, so we'll have them sent here or sent to the client, and they'll bring them to the nonprofits for whatever reason. Most of the time we send it with a little letter directly to the nonprofit for the client's benefit. The QCDs do count towards the client's required minimum distribution. So that's beneficial if they don't need the money and they are charitably inclined, which is the type of person that we're talking about. The QCDs can go to a designated fund, to a field of interest fund. Sarah Carlson, I'm sure that you're rolling your eyes because I'm missing a few types of funds that they can go into. They can go into most things, but they can't go into a donor advised fund directly, which is the one that typically people want to do, and that can't happen. One of the techniques that's often overlooked is just naming a nonprofit as the beneficiary of the retirement plan, or IRA. This does a number of things for the clients. It does accomplish their charitable goals. So assuming that there's some alignment between their charitable desires and inclinations and the balance they have in the qualified plan or IRA, if those two things line up nicely, clearly naming the nonprofit as the beneficiary, and maybe it's a contingent beneficiary. Maybe we're worried about a spouse who can take the IRA as their own still, but maybe second death scenario. So just always keeping that in mind as an option. We can no longer stretch IRAs. So for adult beneficiaries and children who are adults, historically, generally would take that IRA they'd inherit from mom and dad and stretch that out over their lifetime. That's no longer an option. And so inheriting these IRAs has become, it's always been an income tax burden from that perspective. There's some income tax embedded, but the options are a little bit more limited now. And so that's something to keep in mind. It does, if we name a nonprofit as a beneficiary, it does completely avoid the taxation because we're giving the money away. And it also offers a lot of simplicity for people. So if the rules keep changing the way they have, and we have charitable intent, this obviously is a way to simplify the estate plan. One of the big pitfalls that Sheryl may talk about is sometimes clients want to name or leave charitable money from their qualified plan or IRA, but they don't have that conversation with their advisors and they end up leaving it through their estate. And that can really, really complicate things. It can be quite a mess. And so naming a nonprofit as a beneficiary, whether it's primary or contingent, is really the cleanest simplest option, assuming it lines up with their needs, and it's frequently overlooked by our clients. And then I felt the urge to throw this slide in because people generally love the idea of a donor advised fund. It's kind of like your own little type of private foundation, but much, much simpler and cleaner and easier. And as I said earlier, we cannot do a QCD directly into a donor advised fund. So that's a little bit problematic. What we can do, however, is work closely with our tax professionals, and we can figure out if the client takes the income and picks it up on their 1099-R in their tax return, can they offset it with a deduction, a charitable deduction? And if they can, if we present this to the CPA and the CPA says, yeah, we can offset 100% of that income, well, there you go. Now we can take the income, and what we generally would do is maybe we do 2, 3, 4, 5 years worth of giving and take that out of the IRA, give it to the client turns around, gives it to the community foundation, and sets up their donor advised fund. And now they've got a pot of money that they can use for their charitable giving through this donor advised fund. There's an extra step in there, and it is true that we can't directly fund a DAF, but there is a workaround if you're thinking ahead and working with your tax professionals that will work for a lot of people. And I thought at this point, I have an interesting story that would be a nice segue into Cheryl's part of the conversation on split interest gifts. And that is some clients that came to me with the idea of using a charitable remainder trust. And I sat down with the clients, and they had been proposed that concept by a different advisor. And in talking with them, found out they really didn't need any income back off of this. The asset that they had wasn't a qualified plan. So you might wonder, why is Jeff talking about it? What it was completely depreciated farm equipment. So the sale of it is 100% income, which is the same thing as an IRA. So from my perspective, they're very comparable. And we had to go through the effort and the process of working with their tax professionals to say, if they sell this, can they get a deduction if they fund a DAF? Because it turns out they did not need income back from this equipment sale. What they really wanted to do was set aside a pot of money to leave a legacy and to fund their charitable giving and really offset this income that was coming in a bad year for them. They had grain in the bin still. So it was a bad time for them to get all this income foisted upon them. They didn't want to hold the equipment for an extra year for no reason. And so as we went through the process, we realized, yeah, they can hold the sale, they can get the sale proceeds, and then they can fund a DAF, they can put money in a designated fund, whatever it is, but they can pick up the deduction on the other side. I did, just to keep him on his toes, I did throw it out to Steve that we might be giving some equipment to the community foundation, and you guys might need to sell it, and what would that look like? And we went through that process and thought we could probably make that work too. So we were able to offer some solutions for that client. But I thought that was an interesting story and kind of parallel to the idea of the IRAs. So with that, I'll turn it over to Cheryl, unless anybody has a question now, and she can elaborate a little bit more on the split interest gifts.
Thank you. In terms of what Jeff talked about, he talked about discussions with a potential donor around charitable remainder trust for a lifetime gift. And so that is a good segue. I'm going to just cover charitable remainder trusts as one form of split interest gifts. So there are a couple different kinds of split interest gifts. The IRS generally says you can't take a deduction in general for any interest you gift where it is a split interest, meaning there is both a charitable and a non-charitable sort of beneficiary or interest holder. But the IRS has a couple exceptions to that general rule, and the charitable remainder trust is one such exception. So we'll focus on that today. Let's first talk a little bit about what a charitable remainder trust is. And I have this picture that I like to use that really just shows kind of the flow of a charitable remainder trust. And one point to make here on this slide is that a charitable remainder trust can be created during lifetime, or it could be created upon death. And the lifetime creation that Jeff sort of alluded to is generally done when a donor does want to retain an income stream from the asset that they're giving to charity. So they might retain the interest for their lifetime, but the other sort of benefit or planning strategy around a lifetime charitable remainder trust is if the donor is seeking to transfer an appreciated asset to that trust and either minimize or potentially avoid the capital gains that would have happened if the donor had sold the property, recognized gain, and then, potentially made a charitable gift, but needs to retain that income stream. So the charitable remainder trust can be used during lifetime. So in this picture, you'll see the donor makes a gift to the trust. The trust has two interests. It has an interest at the beginning for the donor if it's a lifetime charitable remainder trust, or potentially for the donor's family beneficiaries, whether that's a lifetime gift to a CRT or a gift at death to a CRT. In the end, at the end of the period that's defined in the trust, the charity receives the assets. So this picture is just designed to show you sort of that flow of how a CRT works sort of graphically. So if you could move the slide, Amy. Thank you. So let's talk about a charitable remainder trust. What are the attributes? So first of all, it's irrevocable. Obviously, by definition, if it happens at death, it's irrevocable. But it has to be irrevocable, and it provides for non-charitable beneficiaries for that initial period that is defined in the trust instrument. There's some limitations on how that period can be defined, but in general, it can be for life, or perhaps a stated term of years, or perhaps one of a few permissible combinations of those. At the end of that period, the trust property that remains in the trust will pass on to charity. If this type of trust is created during lifetime by a donor, the donor will receive an income and a gift tax charitable deduction for the value of the charity's interest. And remember, the charity's interest is in the future. So there's a computation that has to happen according to the IRS methodology that determines what is the value of that charity's future interest. It takes into account the term or the life expectancy of the non-charitable person, as well as the prevailing economic situation that might determine what interest rate factor is used for that calculation. If it's created at death under the decedent's or donor's estate plan, whether that's a will or a revocable trust, there would be an estate tax deduction for the actuarial value of that charity's future interest. And in that circumstance, the assumptions at death are what are used to determine the value of the charity's future interest. That charity's future interest has to be equal to a minimum of 10%. And so you can imagine that a testamentary trust, you may or may not be able to consider whether the trust qualifies for that requirement or not. The trust itself is tax exempt, and our CLA folks are going to talk about how the income is handled, but the trust itself is tax exempt. And what that means is that when an asset goes into the trust, if that otherwise would have been viewed as a recognition or a tax recognition effect, the trust is tax exempt. So the trust itself will not pay income tax on its income. Let's flip the slide. There's a couple different kinds of charitable remainder trusts, a basic two type. In the first instance, there's something called a Uni-Trust, and this is the more complex one. A Uni-Trust says that the amount of the payment to the non-charitable beneficiary is determined as a percentage of the fair market value of the trust on the date for typically the first business day of each year. So the amount that gets paid out to the non-charitable beneficiary can change, just as the assets of the trust are changing. And so it could be defined as 5%, which happens to be the minimum, of the value the first business day of every year. And if the trust goes up, then that 5% goes up. If the trust goes down in value, then the 5% changes. There are some other sort of more complex variations on how you can structure that type of trust. There's options to say that it's not just 5% of the initial value at the year, but it might be the lesser of that 5% calculation or the actual income of the trust. That's called a net income variation. The trust can also be structured to flip on a particular date from being just a straight 5% trust to being, or a net income variant to being a straight 5% trust after a particular date. So there's some ins and outs that can be drafted into the trust, but the IRS and the Internal Revenue Code completely defines what these requirements and qualifications are. These kinds of trusts are a creature of the tax code. They didn't exist before the tax code recognized them. And so if you're looking to have a qualified tax exempt charitable remainder trust, the tax code and the IRS's forms are really, really important to follow. The alternative to this type of payment that would change every year is having a payment that just stays the same. That's called an annuity trust. And in that circumstance, the trust says the payment is going to be 5% of the initial value of the assets of the trust. And then that amount never changes. It's just whatever that dollar amount is. And so the annuity trust has a straight, unchanging, always the same amount that gets paid, whereas the Uni-Trust can vary over time. Let's flip the slide. If we're talking about, Jeff talked about a circumstance in which they were looking at making a transfer of equipment to a charitable remainder trust, and did that make sense? For a lifetime transfer, that was a different kind of asset, but in envisioning or talking about the charitable remainder trust. If you're talking about a qualified plan and the interplay with a charitable remainder trust, a donor cannot do a qualified charitable distribution, like Jeff talked about, to a charitable remainder trust. It just isn't allowed. So a lifetime gift of a retirement plan to a CRT is not allowed. It's just not a thing. But at death, the beneficiary designation can name the CRT, a CRT created upon the donor's death, as the beneficiary. So let's talk about that. So in that circumstance, that charitable remainder trust might be a standalone revocable trust. And what I mean by that, this gets a little complicated and maybe above this presentation, but what I mean by that is that the trust has to be a typical revocable trust during the donor's lifetime, because there's a rule that the trust must operate as a charitable remainder trust and therefore make distributions, et cetera, from the date of its creation. And so that requirement is going to be something that means that a person should not create a CRT during lifetime and leave it unfunded until, until the person dies and names the beneficiary as the CRT of their qualified plan. So in that circumstance, what we're, that there's a particular kind of structure that we work with to deal with that issue, or the CRT can be drafted right into the will or revocable trust of the decedent and here the donor. We do recommend that in that case, that the donor's beneficiary designation does not name the estate or revocable trust as a big entity as the beneficiary, because as Jeff mentioned, that can create problems. Instead, the donor should name in the beneficiary designation that the beneficiary of the qualified plan is the charitable trust created under whatever document it is. When it comes to how that works from a tax perspective, because the trust is tax exempt, created at death in a testamentary fashion, the payment of the IRA into that trust is going to be income tax free. So no income tax at that time. The trust is not a designated beneficiary, so the payment into that trust is likely going to be a lump sum, probably not spread out over time. There is also an estate tax deduction, as I mentioned before, for the creation of a testamentary CRT at death for the value of the charity's interest. If the donor names a child, for example, an adult child, as the non-charitable beneficiary, so the person who's going to get those Uni-Trust or Annuity Trust payments, that person's interest is going to be subject to estate tax and whatever calculations and exemptions the donor has. And it's all actuarially calculated. One of the uses that is being talked about a lot for testamentary CRTs is this issue that Jeff mentioned about the Secure Act, which really limits the ability to stretch an IRA payment out over a recipient's lifetime. The changes mean that there's oftentimes a 10-year payout requirement, which means that person must recognize income tax over that 10-year period on those changes or on those payments. Whereas what's being talked about is sometimes people might think about using a charitable remainder trust as the recipient of the IRA benefits, but that charitable remainder trust will include a lifetime payout for the beneficiary. So the account from the IRA goes into a trust, and then the trust terms say that the payment in is tax exempt, but then the non-charitable recipient, the child, for example, can receive payments calculated based on that person's life expectancy. And then that recipient, will just receive it over their lifetime or whatever that defined term is. And so one of the benefits of a CRT under the current law is that you can sort of avoid that 10-year payout requirement and have the assets go into a trust for somebody who might need protection of a trust. And so somebody who might need protection could be, a minor or spendthrift type of beneficiary, could be a spouse. So, instead of naming that person individually as a beneficiary on the account, you could put that account into a testamentary CRT, get a charitable deduction depending on the age of the person and the qualification, but be able to sort of force spreading out those payments to that person to their lifetime in a tax world where we can't do that otherwise. We do that kind of planning a fair amount. We did that kind of planning before the Secure Act came into being. We have donors, and I've got 3 estates recently where we did this, where what the donor really wanted was to provide for the spouse over their lifetime, kind of a specific set in stone type of payment, rather than leave the asset outright, and then wanted to benefit charity. So we used a CRT as the beneficiary of their IRA, and we're administering, a handful of those right now. So it's not uncommon in my practice to see that sort of planning. And I think that's the end of my slides. Amy, if you want to turn it. I do have a question then to the CLA folks. I talked about the fact that the trust is tax exempt, but that doesn't mean there's no tax. So maybe if you folks can talk about where the taxes come into play here.
Thank you, Cheryl. Hi, everyone. Andrew here. I'm with Cindy, and we're going to just chat a bit about how the taxes are paid by the recipient. One thing to keep in mind, these are very complicated, and I would urge anyone who's considering one of these to work with your professionals, the group of professionals in your sphere of influence, and really determine if this is what you want to do either now or at death, because once you do it, you're kind of stuck once the money gets put in there. So you got to be careful to make sure this is really what you want to do, but ultimately it can be a great tool both to help out your family or your heirs, and then also the charities that we all hold so dear. So when I receive money from a CRT, from a charitable remainder trust, first of all, that is taxable as income, and they're taxable as income each year in which they're paid. Now, because the income is coming from a trust, trusts do create a different document. Some of you might be familiar with the 1099 or or a W-2 when you show that you've received income, but we're going to receive what's called a K-1 from the trust. That will indicate then how that taxation is going to be shown to you on your tax return. And one of the challenges of the CRT is that it comes out in a rule called worst in, first out. You maybe have heard in, first out, or last in, first out. Well, in our world of the CRT, it's worst in, first out. And what does that mean? That ultimately it's going to come out ordinary income for the first bucket of money that comes out. So ordinary taxable income, ordinary taxable interest, it'll all be ordinary income, subject to whatever the beneficiary's tax bracket is. So if you're otherwise making good money, you might be in the highest tax bracket. So it might be as high as 37%. You'll have to pay state tax, but ultimately, depending on what tax bracket you're in, that's what level of taxation you'll pay. Then the next bucket will be qualified dividends and capital gains. And then lastly, accumulated income and capital gains. So a lot of complexity here. You'll want to work with your tax advisor to determine, how this affects you from a tax perspective, but just be careful that you understand the rules and how you're going to be taxed as a beneficiary. And could you flip the slide, please? The trust itself is an entity. And so as an entity, it's going to have to file a tax return, and it's going to use a form 5227 to do the split interest. And the income will be reported. In there'll be a balance sheet on monies that are coming in or monies that are due. And again, we'll issue the K-1, and the distributions at the end of the term of the trust will be made for charitable purposes. So at the end of the term, once all the income has been paid out, the beneficiary term in the trust is gone, the money that's left will then be paid out to charity. So ours is a very short section here at the end. We have a little bit of a Q&A session coming up, but ultimately you're going to have to pay income on it, and you'll want to work closely with your tax advisors to make sure that income paid right, that income is paid right. And then secondly, the CRT itself is going to have to file a tax return, so that'll add some additional costs there as well. Not only will it affect your individual return, you'll have to file a return for the CRT as well. And that's all I have for you. What questions do we have, Steve?
Hi, everyone. We do have a couple of questions that have come into the chat, so we'll handle this first one, most recent one, right away. And that is, could a farmer donate a crop to a CRT, avoiding income tax and estate tax, and still get a deduction for production cost and a charitable deduction?
I can comment on that. And CLA might want to weigh in as well, but typically for something like crops, the basis that the farmer, there's this rule that covers what deduction for income tax purposes a person can take depending on the type of property. Where you have property with ordinary income attributes, meaning that if the donor sold it, it would be ordinary income to the donor. The difference between the donor's basis and the fair market value of the sale, if that difference would be ordinary income, then the donor cannot take a charitable deduction for anything more than his basis in the property. So for a donor looking to donate crops, the charitable deduction is probably not going to be significant because of that rule. Really what the donor is looking to do, however, is to, it's not really the focus is not really the charitable deduction up front, but instead the tax exempt nature of the trust, such that if the donor donates the crops to the CRUT or the CRT and then the CRT sells the assets, that sale is tax exempt. And so then the income will dribble out to the farmer over time. So really the CRT is a way of deferring the income tax distributions to the donor so that it's not just all happening at once, the income tax, but instead that it's happening over time, which can be a good thing. And it allows the charitable trust to invest the full amount and therefore realize income on the full amount versus the farmer selling it, recognizing income right away, and then having a smaller pot to work with. So that's typically how it's going to work.
Andrew or Cindy, is there anything you'd want to add to what Cheryl just mentioned about that?
I was just going to add that it would be similar to the situation with the fully depreciated equipment. It's a way to, as Cheryl said too, you defer the income. So instead of paying the tax all in 1 year, you'll get the payments over your lifetime or term of years. And so you'll be paying the income tax over that term of years, hopefully at a lower tax rate than if you recognized it all in the 1 year.
Thank you. Another question that's come in is there a certain type of client that would be likely to do a CRT, like age or maybe their sector or background that they worked in, family makeup? Who would be the most beneficial client for a CRT?
Well, I can comment that because of that 10% requirement for the charitable interest at the end of the day, the actuarial calculations would result in a conclusion, and I don't know the numbers exactly today, but would result in a conclusion that a person can be, if they're looking for a charitable deduction during lifetime, for a lifetime charitable remainder trust, if they're too young, that calculation doesn't work. And so that might just, take somebody out of the consideration because of that.
All right, and there's a follow-up question regarding the transference of the crop to the trust, and that is, so by transferring that crop into the trust, you would avoid SE tax? That's the question.
I believe that is the case, but I'm not. Okay, Cheryl's nodding her head that yes, that would. You're on mute, Cheryl.
Thank you. I can't, I'm trying to remember if I've looked at that question before. I don't know that I have, but you would think logically that if the trust is the owner and selling it, and there shouldn't be any tax recognition at all upon the funding of the trust, as long as you avoid something called a prearranged sale, you would think it would not be subject to the self-employment tax, but I don't know.
Sarah, can we go back to your previous question quick on the type of client that might be a good client for a CRT?
Of course.
There's a couple situations that we've worked with where it made a lot of sense. One was a sad story. It was a husband and wife that had a very large stock position with a huge capital gain in it. And the wife was not in great health and they had no kids. So it was actually his stock. So he put it in the CRT, provided income for him while he was alive. And then when they were both gone, the intent was to give the rest of the money to the Cancer Society or to charity in general for cancer, because she was sick with cancer. And so in that situation, they really didn't need to recognize that gain. They really didn't need the money. They had no heirs to give it to. And so it was a win-win for them to be able to provide her some lifetime intrinsic value of being able to know that she's giving to charity, avoid taxation on the gain of the sale, and then have income for the rest of their lives. Another client that we worked with had a very, very large IRA. It was well over $5 million. And they did have, so the way they structured it is they had the spouse as the beneficiary, and then the CRT was as a contingent beneficiary. And through the use of a disclaimer, the spouse could determine how much money she needed to keep and then disclaim the rest of the assets to the CRT. And so there's some really cool things you can do with it. It is very complicated, and I think people need help, but it generally tends to be a better strategy for wealthy folks that have either an income need now and a large gain outside of their IRA, or for families that do have beneficiaries and they want to either protect those beneficiaries or provide to the beneficiaries as well as a charitable intent. So, but it generally tends to be wealthier folks that use them.
And Sarah, just to add to Andrew's comments, a couple things that I generally see or kind of look for would be, and Andrew kind of hit at it, but concentration of assets. If you've got a huge position in a stock that because of the capital gain, you can't really sell, and they need, they can't afford to give it away. They need some income off of it. They would like to sell it, but maybe you just can't afford to deal with the tax burden. Well, there you now you put it in there, sell it, get the income back off it. So it's a really good way to diversify a highly appreciated, concentrated position. We saw it with was the company that sold to Ireland, a few years ago out of Minneapolis. We had clients with really low basis and got hammered with the capital gains, and they looked at, do we do charitable remainder trust so we could sell this and keep it in a way. I also think it takes a little bit more sophisticated type of client. This is not a revocable living trust. And most of the time, in my experience, we might know something's great for them as their advisors, but if they can't at least wrap their head around the idea, they're probably never going to really be comfortable with it. And if they're not comfortable with it, they're not really going to enjoy the experience of having it. And so it does take somebody who can, at least at a high level, grasp the idea of these fairly complex topics.
I might also weigh in where we have a situation, or there might be a situation where somebody maybe doesn't have the large, they want to make a charitable gift. They want to, spread out some gain or income, and they want to do that, but with a smaller asset. And they want to retain the income stream. For somebody like that, there's obviously a cost of setting up a charitable remainder trust. I mean, you probably, hopefully need your lawyer and your accountant, and, there's complexity associated with it. But for somebody who's looking at maybe a smaller gift, but has some of the same objectives, an alternative might be a charitable gift annuity. And a charitable gift annuity looks a bit like a charitable remainder trust in structure, in the sense that the donor or the donor's spouse can retain an income stream. They would gift the assets to the charity. So it is an irrevocable gift to the charity, but there's no trust involved. It's really just a contract. And under that, the charity would agree to make payments to, in exchange for this gift, make payments to the donor or the spouse, or however the contract reads, to a person for a period of time, lifetime typically. And so they still get the income stream. They've made a charitable gift. There is a 10% requirement, all of those things, but it's not a trust. It doesn't file its own tax returns. There's not sort of these forms and these things to wend your way through in the tax code. If, assuming your chosen charity will accept a charitable gift annuity, some charities don't do them, but many do. Many charities are willing to do those for amounts, $10,000 even, as low as that. And so somebody who maybe isn't looking to make the big splash and the big gift, but has some of these same considerations, they might look to a charitable gift annuity.
Thank you all. Cindy, is there something?
Just to add to that, with the charitable gift annuity, the beneficiary would still have to report income.
Mm-hmm.
The charity would be issuing a 1099 to them each year, not a K-1, but just a 1099 showing the income that they have to report.
Thank you all. We at Community Giving do, and all of our partner foundations do actually partner with your donors on charitable gift annuities. So if that is something that you have a client in your portfolio that would be suited for that strategy that Cheryl and the team have just laid out, please do give your local executive director a call, and we can help run some scenarios and get some additional information for you and your advisor team to make the final decision about if this tool makes the most sense. And then we can be a partner to help execute that strategy. So the next question.
Is there a minimum, Sarah, for your charitable gift annuities? Is there a
Well,
minimum?
we have to do the calculations to determine, just like, are we talking 2 lives? How old is that donor? So we would just want a chance to run those calculations and then present that back. And then you all are best equipped to help them make the final decision on that, whether a CGA makes sense for them. So the next question is, what do you recommend the size of a gift be to create a CRT? Is there a minimum amount that you would recommend to a client who's considering this?
Well, and, you know, I've seen as little as $100,000. But in that circumstance, you know, we were working with actually the charity, and we have a long standing relationship with the charity, and we kind of know them and have a process where we can keep the costs down. You know, it's still costly. It can be, you know, $3,000, $4,000, $5,000 to set up a CRT. But, you know, depending on the circumstance, we have seen that happen. And we always ask twice, are they sure they want to do that versus a CGA? But, you know, we've seen that. It's probably not optimal. You know, Cindy and Andrew, I think, you know, we had some background discussions, and I think your thoughts were maybe closer to the $500,000. I agree with you, although I've seen them done for less than that.
And I've seen them done for less than 500,000 also, but typically that's been one where they got the tax deduction because it was capital property that had a large gain built in. So something they did during life got the income tax deduction, and then also the charitable.
And I would echo both those comments. I think if I saw one or had one suggested to me at the, you know, 100,000 or that ballpark, I would kind of cringe and say there's probably a better solution here. Seen them, administered them, they exist. Not ideal. And I don't know that there's a perfect number, but there's hard costs with administering a charitable remainder trust. And if it's smaller, those hard costs as a percentage are higher. If it's $5,000 and you're only going to get $4,000 a year of income out of it, there's your first year and a quarter of income gone to setting it up. So I think those kind of things have to be examined.
Thank you. The next question we have is thoughts on trusteeship of CRTs, and they can be self or trusted advisor or a trust company. Anyone want to give some comments about trusteeship of a charitable remainder trust?
We selfishly, we at Bremer love to be trustee of all forms of trust. Charitable remainder trust would not be an exception to that. And I'm sure Andrew probably has some thoughts on that as well. So I think, yeah, most of the time we do see people working with advisors on those. And I haven't seen too many that are self-trusted. Of course, if they are, I may not see them. So Cheryl probably have a little better perspective on that.
Sure. You know, we do see self-trustee trusts, but typically, you know, I guess if I had to find when that's typical, I think when we have seen it, when it's typical is where the trust is, you know, one of the simpler kinds, or when it's going to be, if you saw in one of those slides, a flip crut, so that at the beginning, maybe the donor is putting a piece of real estate in there. And so there's just not much going on, you know, and maybe not even any income to deal with. And then when the property sells, then the donor would back out and get a third-party trustee in there to manage the fund at that point. So that's sometimes what we see. I mean, if again, I had to figure out where it's more common, we see it then. Any trustee like Bremer obviously knows what it's doing. But if a donor is going to be trustee, or a charity is thinking about being trustee, which is allowed in Minnesota under certain circumstances, you really do have to know what you're doing. And you have to have, you know, sufficient accounting or back office support to be able to do the tax reporting, do the donor reporting, know what kinds of investments are appropriate, et cetera.
And to that point, Cheryl, I would just say, you know, Andrew brought up earlier the example of highly appreciated stock. So you put that into a charitable remainder trust, sell it. Now that income that comes out is long-term capital gain over time, preferential. But because of the WIFO rule, if the trustee doesn't know what they're doing and they put it in a bank account, it earns ordinary income. That ordinary income is what you're going to get. And so, you know, there's a number of components to administering those, and equally important is how you invest it after the fact to make sure you actually get that capital gain taxation out of that. You have to make that the worst taxation in order to get it out. So the only way you're going to really get it out is to only earn capital gains that are long-term or muni bond income.
Thank you. This is a broader question about some strategies behind educating survivors or beneficiaries about tax implications. So how do you recommend educating survivors or beneficiaries about the tax implications and their options when receiving a qualified plan as an estate gift? And do you have any tips or tricks to assist in that education process?
The first thing I would say, I've got an echo. I'm not sure if someone else was.
You're okay, go ahead.
Okay. That the important thing is to educate people to come to the professionals before you do any signing, filling out documents from companies or insurance companies, that type of thing. To talk to your professionals first so that you have an idea of what might happen. We had the case recently where their mother died with a bunch of annuities, but the beneficiary signed all the paperwork and sent it back in and then came to us. At that point, there wasn't anything we could do.
Anyone else have thoughts about this particular question?
Yeah, I'd agree. You just want to be careful to educate your clients on what's happening and how they work and what your options are. Certainly CRTs play a role in the process, but there's other options or opportunities too. And you really want to look at what the goals of the beneficiary are. Secondly, though, if they do have a CRT in place and they are going to be receiving income, again, to Jeff's point, you'll want to make sure that it's advised well. There's a competent trustee involved, and yes, those things cost money, but it's sometimes you get what you pay for, so it's worth paying for the professional advice. And so ultimately, just get help, ask for help. You know, that's really my biggest thing, is ask for help from people who know what they're doing, and try not to make a mistake that you know in the future can't change.
And I would just add to, be educated on what your options are. And those options are fewer now than they were a year ago. And so if you inherit an IRA, it's ordinary income. And you can decide when you're going to take it, and you need help from your CPA and your professionals on that, but it's going to be ordinary income. There's nothing you can do about that. If you're named the beneficiary, that's that. So I suppose you could disclaim, right, Cheryl? I mean, there's a few options there, but then you're just giving the money away, which is the same as just donating it. So if you want to keep it, it's ordinary income, and there's not a lot you can do about it other than figuring out what timeline makes the most sense for you to draw it. But we have fewer tools, in the arsenal than we did a year ago or a year and a half ago.
Thank you. So the last question that I have, I'm going to pose to the entire panel and let everyone have a chance to answer. We'll start with Jeff since he's on screen right now. And that is a more general question. How do you find it's most beneficial, or you find your clients most receptive when you bring up the idea of charitable giving in your conversations with your clients? Is there a strategy that you use that's been particularly effective, or advice you would have about how to do that, Jeff?
Well, thanks for having me go first on that one. I think from my perspective, it's not beneficial if I bring it up. It's beneficial if they bring it up. Whether bring it up means they actually come in and say, we'd like to be more philanthropic, we don't know what to do, or we just are processing QCDs for them, or maybe even donations to charities from their trust or their agency account, however it may be. When we pick up from somebody, from their signaling or their actual conversation, that they're philanthropic, that's the green light to start to share with them, hey, here's some of the tools. Knowing your assets and knowing what you do at what levels, and ask some questions to find out what those levels are. Then you can start to hone in on, do they need something a little bit more complicated? Do they need a split interest gift because they need some income back? Maybe we can find a deduction, maybe we can eliminate a concentration. Or are they just philanthropic, and can we work through QCDs and giving to the community foundation to fund your goals that way? So I think there are ways to bring it up, and I definitely, in the estate planning or really planning process, I always ask whether or not they're philanthropic, and I don't try to, define that for them. If it needs to be a certain, do you give any money to any nonprofits at all? And they usually say yes or no. And if they say yes, then we can start to uncover that a little bit. And if they say no, then you probably just don't want to bring it up again, at least at that time. So that would be my 2 cents, is let the client drive that conversation. And then when you pick up on the signals, start to show them the tools.
Cindy?
I just wanted to add that sometimes a client doesn't even realize what a nonprofit is. I've had a couple of clients that it totally floored me, but they said, "Oh, does my church count?" They had no idea just what all is included as a nonprofit that you could give a deductible gift to. The other point I would make is that if we know ahead of time when someone is like planning the sale of a business or a large holding of stock, that we could ask them if they might be interested in a charitable donation and explain to them how it benefits them. Because sometimes they can definitely come out way ahead than if they didn't use the charitable vehicle.
Thank you. Andrew, anything you'd like to add to that conversation?
Yeah, sure. I guess, at CLA, one of our things is we really believe in taking a seamless approach from both the wealth advisory and a tax approach. And so oftentimes we'll look with our clients together and just see what the situation is. You'll find that, in my opinion anyway, when you do financial planning and look at a client's goals and what's really, really important to them, and forget the money matters, but get to the heart matters, and you see in their heart there's a desire to give, that's when you can start to approach what we would call legacy planning. And certainly there's competing priorities, right? We might want to give money to kids, we might want to give money to our alma mater, we might want to give money to something else. And so really the complexities there, in line with their tax situation, we can really take a look at how best can we achieve the goals that you have stated, and CRTs can play a role in that. As far as trigger events, if they itemize and they have a large charitable deduction, if you notice there's QCDs on their tax return, if they talk charity, if they are active members of churches or Rotary clubs or Lions events, there's a lot of reasons or ways you can look at it. But ultimately, it's a matter of the heart, and finding that out about your client. First, I find a lot of value in that, but second, that's where you really can find out, how can we best help them.
Thank you. And Cheryl, anything you'd like to add on this last question?
Yeah, I would echo what others have said, and I think, I in my experience, the donor or client really has to be charitable. I mean, they have to be philanthropic, because trying to insert, philanthropy into something to get ahead, if you will, or to get, to end up better off than you were, there is always a charitable gift involved. And so, it's something where, we typically aren't working with donors solely on a tax transaction. Instead, it really needs to fit within their general philanthropic bent. So as Andrew said, the matters of the heart. So.
Well, thank you all. I'm going to turn it over to my colleague Holly Witt with the Alexandria Area Community Foundation for some closing comments. Holly?
Thanks, Sarah. So we'd like to just thank everyone for attending today, and thanks so much to our speakers for the great presentation, a lot of technical information there, but you did a great job, so thank you. Just an FYI, we will be taking a break in July from our webinars, but look for us this late summer, fall, we'll be back again with continued webinars. One final thing that we would like to mention before we end the webinar today is we'd like to recognize our colleague, Carol Turnout. Carol is retiring, as most of you know, and she will be done with Foundation next week. And we are just so grateful for your leadership, Carol, and we're really going to miss you. So we just want to thank you publicly here, and thank you for all you've done. and we're going to miss having you. So thanks, everyone. Watch for us to come back next late summer, early fall. Here's some additional information. You can go back and look at previous webinars if you're interested. Go to our website, communitygiving.org, and you can find some previous webinars. So thanks again, everyone. Have a great day. Bye-bye.